This is Today in Money. I'm Jim Goddard. My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to Today in Money.
Yeah, Jim, good to be with you. And it's Friday morning, and you know we have our listeners out there. I know they're out there.
Yes, and we have a listener question to kick off the show.
Terrific.
This is from DW. In the next few years, as the U.S. dollar gets chronically firm, where does Bob see inflation and CPI figures in the short term, medium term, and longer term?
Oh, please define short term, medium term, and longer term. Anyways, good question. And I like my description of the senior currency becoming chronically firm. And that's what a couple hundred years of history says, that once you're past the Great Bubble, then the senior currency gets firmer. And one explanation I came up with, it's now, of course, New York is the financial center, and the U.S. dollar is the senior currency. Before the 1920s, it was London as the financial center and sterling as the senior currency. And you can go all the way back to Roman times with that story. And one of the things about it is the move to the financial center with the senior currency is not a government option. They don't decide it. Market forces decide it. So anyways, yeah, the firming dollar, not yet, but it looks like it's built a 4 or 5 month base. It had a low 3 or 4 weeks ago and is up a little. So if we can watch it test the low, and if it moves up, then that would be exciting. And it would be part of other things. One would be commodities generally weakening, and the other would be real long interest rates going up. So, but we're not there yet. Earlier in the year, like March, we thought, ooh, this is shaping up. It could become another great bubble. And it has become another great bubble. And then I pointed out that in New York, the 1929 Great Bubble peaked on September 3rd, and in the 1873 Great Bubble, it peaked, as best you can tell, as September, and then you went into a contraction. But now, this has got a lot going for it. And you've got the Republicans in the states could come out of the midterm elections in November rather favorably, and that would be a plus. And then you have all of the incredible business and investment money coming into the New York thanks to Trump's tariffs. So that's a great plus for the U.S. But also I'm going to add that part of his tariff plan is that prior to the start of income taxes with the 1914-18 war, all taxes were tariffs and on stuff coming in, and excise taxes and stuff like that. So it was an abomination when they started taxing a person's income before they really had it. And the start of the income tax was quite provocative. So I believe that part of his tariff plan is to get all of the U.S. funding off of tariffs and end income tax. The Internal Revenue Service would be shut down. Now, if they end income tax in the U.S., Canada would have to end income tax. It would be so powerful, and it'll shock the authoritarian government in Ottawa all to hell. I'm looking forward to that. Mm-hmm. So So this is where we're looking at is now one of the explanations for the reserve senior currency becoming chronically firm is that during the bubble, the stock market gets all of the attention, but there's a huge bubble in bond issues. And what happens when the party is over? The focus swings to those who issued bonds have the problem of servicing said bonds. They got to pay the interest and retire the bonds. And in this case, New York into New York with U.S. dollars. So in effect, Jim, this great, the bond side, the debt side of the great bubble is essentially a huge short position of dollars. And it's going to be really interesting on, we'll use it, short term, medium term, and longer term.
Now, this just came in. The Canadian GDP in the last quarter was 3.3%, ending the technical recession where the economy had dropped 0.1 and 0.2% over 2 quarters. And they said, well, even that wasn't as bad as it was because they've revised the figures like they like to do. Can we trust these numbers, Bob?
Oh, not with, no. They will do, Statistics Canada will do whatever they can to make the number a happy one, no matter what. And, but we have the boom going on in the States. So that is going to be lifting, as they say, all ships in the harbor, including the derelicts in Canada.
We'll have more with Bob Hoye, taking a look at some of the headlines that caught his eye right after this. Always consult your investment professional before making any investment decision. Today in Money is archived on YouTube at Talk Digital Network. We're speaking with Bob Hoye. Headline, Bob, from Yahoo Finance. A race to the bottom. TD downgrades Bell, Rogers, TELUS as wireless price war intensifies.
Oh, yeah. Yeah, it's getting quite vicious. Toronto Dominion Bank is key thing, downgrading various debt. In this case, it's Rogers and TELUS, as the wireless price war intensifies. Yeah, that explains a lot.
From What's Up With That headline, Hollywood's climate change campaign falls flat with voters.
Yeah, well, Hollywood really is all politically very left. And, of course, they got on the whole bandwagon about climate change. And basically the reason why it was promoted is that, one, it was a means to tax people. 2, they then took that tax money and used it to order you what to do. I mean, definitely not democratic. And then as far as the science goes, it's absolutely dream world stuff. The amount of carbon dioxide in the air is like 0.04%. I mean, it's always considered as a trace gas in the atmosphere, whereas nitrogen and I can't remember the other one make up something like 90% of gas in the atmosphere. So the only reason why we've had climate hysteria is because authoritarian governments and bureaucrats have wanted to tax people to death and control them. And the story is utter nonsense. You take a recent poll of people's concerns, and it's way down, number 10. And maybe on a list of 10, it's the 10th one down. But it's the story amongst the public is faded a huge amount.
From Drudge, the headline, the AI prodigy who won over Silicon Valley and then lost $45 billion.
Yeah, some young guy in his maybe just turning 20 had come up with something phenomenal in the AI. Well, I like the term, Jim, prodigy. And then it didn't work out, and somebody lost $45 billion.
Well, one of the problems I've been told by people with all this money being poured into AI, trillions of dollars, there's no way they can ever get that money back. It's just, it's like the start of, is this like, my question is this like when the automobile business first started, there were hundreds and hundreds of automobile makers, and then eventually it came down to just the big three in North America.
Yeah. Well, in the big high-tech darling, and I've mentioned this before, in 1929 was Radio Corp of America. My God, that was everything. And it got up to something like $125. And in September 1929, and by 1932, it was down to about $1.25. And 29 on the boom, they were buying it, looking for $3 a share earnings. Well, the earnings disappeared, and they lost money for many years, and they didn't get back up to earnings and $3 a share until 1955 or 56, I guess it was, with the Elvis Presley contract. And then Radio Corp made huge. And then we also got to go back to the 1873 bubble, when the big high-tech was Western Union Telegraph. Oh, that was the big deal. Also, they were providing the ticker tape into offices everywhere. On the ticker tape, of course, displaying New York Stock Exchange stock trades. So that was a dazzler. And then I've mentioned that when Western Union failed, it gave up something like 40% in 4 weeks. It was in a week, just like that. The big favorite stock, when they hit, they get hit. So take a look at your list of big favorite stocks now. And I'm not saying they're going to go down now, but when the bubble is over, just look at the example, previous examples in previous bubbles. Very straightforward.
Now, we haven't talked about gold for a while, Bob. What's going on there?
Oh, it had a wonderfully speculative flurry right up until into January, February. And actually, it was an outstanding rally. And many central bankers were considering gold as a reserve, but they must have just got on the happy wagon. And but now, that kind of spike up deserved one hell of a correction, which we've been getting. But it looks, now also keep in mind that I focus on the real price of gold. If you focus on the price of gold in New York in U.S. dollars, it doesn't tell you a damn thing. Whereas if you look at gold divided by the CRB Commodities Index, the CRB Commodities Index is a practical proxy for the costs of mining. And if you can have gold going to $20,000, but if crude oil is going to 500, energy costs are going to be going up. So the key is gold's price relative to the costs of mining. And so I used gold divided by the CRB, and it got up to 175 in January. and then it sold off to 101 in July, and now it's sort of 117. No, sorry, it's now 115, and the 20-week moving average is at 117. So I think it's had a severe shakeout, and it's stabilizing, and if and when the financial troubles arrive, then gold's real price goes up. But that doesn't mean that the gold stocks are going to go up, because they're vulnerable to what goes on in New York. And if you have a bad down market for New York, gold stocks are going to go down with it. But in the sector, we prefer the junior golds, and we keep a list of these junior golds. I think there's 11 in there, and we keep running it for, I guess, a year and a half now, and there's been some good stories there, like in the sense that rallied, and there was a couple of turkeys that didn't work out, but generally the book of them has been very good. So the other thing is that, of course, senior gold stocks will go up, but you're just going to get market performance. On the junior golds, if somebody makes a discovery, a global discovery, and then that one, then they become world games. And Poseidon was one a long time ago, and then Arequipa, and that was 1996. Arequipa came up with a tremendous discovery, and the stock, which had started at pennies, was taken over by Barrick Gold, and the market cap was $1 billion. So that I think in stock prices it went from pennies up to $30. Hey, is that a good story or not? Yeah. So this is where I really like the juniors, because they will go up as a book faster than the seniors, and if one of them has a discovery, then the whole sector can get very hot. So good times ahead for on the longer term for the junior golds.
And our last headline of the show from Reuters: anxious investors hope for clarity on Kevin Warsh's Fed plan at Jackson Hole.
Oh, yeah. Well, I think it's right now is when all the Fed guys and senior Treasury guys and everything else get together for a confab at Jackson Hole, Wyoming. So on my piece, I wrote about the one time I skied at Jackson Hole, and it was in January of that year, snowing like mad. We had deep snow, and there was only about 8 or 9 of us skiing, and that included the ski patrol. So the way it worked, it's just, you can't believe this. We'd all keep together as we were skiing down through the powder, and then come down to the aerial tram for going back up. It would be parked there, not operating. So our group, maybe of 10 people, including ski patrol, we'd all get on, and they would start up the cable car. I mean, it is, you can't believe stories like that. But it was Jackson Hole. Every time I see them having this confab, I go back to when I was skiing there. And then also, I've not been there in the summer, but pictures I see are absolutely terrific.
So, are they going to hike interest rates after their meeting or not?
Oh, yeah, they focus on the interest rates as if the Fed can influence interest rates, but it can't. We've got a long-term chart going back to the start of the Fed in Christmas 1913, and it is the T-bill which goes up and down due to market forces, and the Fed funds rate, which goes up and down with the open market committees setting it. But the chart shows that the market rate, T-bills, leads the Fed on whatever it's going to do. So recently, well, for the end of the bubble, you got to have T-bill rates going up. And we had a little blip up here recently. I'm going to see if it goes any higher. But that's it. And then here is one of the greatest ironies in economic thought. They really think that if the Fed lowers interest rates, everything will be well. But if you take a look at this chart and learn one rule, short rates go up in a boom, and short rates go down in the bust. And they really go down. So in June 1929, the 3-month Treasury bill rate was at a little over 5%. And then in July 1932, which was, I guess, the worst of the first contraction, it was down to 0.08%. So I've got this well documented, and when short rates are going down, run for the hills. Don't try and trade it. It's the short rates falling is the worst thing that can happen. Short rates going up says the boom is on. Well, maybe the short rates will continue up into later in the year. I don't know, but we're watching for it.
Bob, always fun chatting with you.
Jim, enjoyed it today, and we'll look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@housestreet.com. Find us on X @HoweStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening. Comments made on Today in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Today in Money is a production of Howe Street Media Incorporated. Executive producer, Tom Allen.